Howdy everyone, I'm Norman Wildberger, mathematician turned banker. Today I'm going to tell you about the fundamentals of central banking. A central bank is a national bank or reserve bank, there are other terms for it, that plays an intermediary role between the government of a country and the commercial banks of that country. So it's very much like a regional reserve bank that I've talked about already in a previous video, but it has a bigger and a more important role because it's also intimately connected with the currency of the government as controlled by the Treasury. Okay, so in the 1890s, I may have told you that I was enlisted by the national government to go off to Europe on a fact-finding expedition to frame a report on the establishment of a national bank. And so today I want to sort of just give you the overall general idea of what a central bank is. So what is the idea of a central bank? Why do we have central banks? Well, there's a number of reasons. I think the first and primary reason is to maintain the stability of the national banking system. In other words, the commercial banks. The second is to preserve the integrity of the national currency. That's especially important these days because most countries have gone off the gold standard and have fiat currencies, and so it's a much more delicate situation in terms of the fluidity and interchange of currencies. And the third is very much along the lines of the regional reserve bank that I've already told you about. It's to facilitate transactions between commercial banks and also between the commercial banks and government. Now, there is, however, a fourth general aim, which you're not going to hear discussed officially, but which plays a big role behind the scenes. And this was also true in the discussion of the regional reserve bank when we were setting that up. Okay? The fourth unstated aim is to make public money available for use by governments, by the national government. Okay, so this turns out to be a very big motivator for governments to create central banks because it gives them access to people's money. Now, if you're watching in modern times, say around 2021, where actually the issue of central banks and their role is actually very important because the central banks are doing very unusual things, okay, in a major way that could very well have drastic implications for our entire lifestyles. But if you're watching at this point, you may have heard something quite different about the role or the aims of your central bank or your national bank or your reserve bank. So these days, banks are oriented towards keeping inflation within a certain bound, certain range. They're oriented towards controlling interest rates. That's another main aim. This is called monetary policy. Controlling the interest rates has a lot of effect on the economy overall. Another one is to keep unemployment at acceptable level. And another very general one is to promote economic growth and productivity of the country. Now, these are all very laudable aims and no doubt play an important part of the consideration of modern central banks. But I don't want you to forget that actually this principal aim here, okay, trumps all of these in a heartbeat, okay? To maintain the stability of the national banking system, that is always first and foremost the main aim of a central bank, even though they may not be saying that. Okay, so a lot of these things here are done with a view of the stability. So we're going to have to talk about why is this stability so important? Why is it necessary for central banks to have such a conservative, safety-oriented position? So the reality is that modern banking is inherently risky and potentially unstable. And the reason is very simple. It's because the loans and the credit, these two things that banks establish, they are only partially supported by deposits. So let me make sure you understand this point by having another look at the balance sheet of a bank, assets, liabilities. On the asset side, loans and deposits. On the liability side, various kinds of accounts and also some capital, which I haven't put in. Okay, so let's have a very simple situation. Suppose that we have one depositor who comes to the bank with $100 cash. And when I say cash, I mean like paper cash. This is $100 Australian, okay? But let's say, $100 in whatever currency you're in. Okay, so what happens is that the bank creates a ledger account here, $100 in the deposit side on the assets, and it creates a deposit account to you if you're depositing the $100. Okay, so that's what happens initially. Now, what happens then to this $100? Well, there's a kind of an old-fashioned way of thinking about what banks do called fractional reserve banking that I've already talked about in this video, coin, cash and credit, and fractional reserve banking. You might want to review that. And then there's actually the sort of modern reality, which is very different from fractional reserve banking. It's, I think, better expressed by the phrase loan credit creation. And I think this is a really good phrase that really cuts to the heart of what's really going on. So I want to explain this. It's really important to be able to understand these two things and how they effectively amount to the same thing. So suppose that we are working in a rather primitive fractional reserve banking system. That means that you give me your $100, I'm the banker, then I'm going to deposit, I'm going to take a fraction of that and I'm going to put that in my vault, and then I'm going to loan out the rest of the money to try to make some loans so I can make some money. Now what happens when I lend this out, then eventually whoever I lend it to will use it to pay somebody else, and then that person will hopefully come back and deposit it again into my account, at which point I will take that and take the percentage that I take for a deposit and then loan out the rest. So the money circulates like this, like I've already explained. And ultimately, generally what happens is that, after a certain period of time, all of the money essentially ends up in my vault. And how much loans and credits are correspondingly created depends on my reserve ratio. So for the sake of argument, let's consider a reserve ratio of 5%. Okay, that means that you give me $100, I'm going to take $5 and put that in reserves, and I'm going to loan out the other $95. Okay, so that's a 5% or 0.05, that's the reserve ratio. And in the calculation that I showed you in this video, I showed you that then the result of that would be that certain loans are created to the public, and that the total amount of loans that are going to be generated by this principle of $100 is the 100 times a certain factor. And the factor was, if you remember, 1 over R minus 1. So if R is 0.05, which is the same as 1 over 20, then 1 over R is 1 over 1 over 20, which is 20. So we get 20 minus 1, which is 19. So in other words, we take the principal, which is $100, we multiply by 19, we get $1,900. That's the total amount of loans that are going to be generated by this $100 in cash by the time it's circulated through the system enough times so that eventually all of it is in my vault. So what's going to happen after all of this has happened and the money has passed around many, many times and come back and then I've redistributed it again, is that I've got $1,900 worth of loans here on the asset side, and I've also created credit accounts correspondingly for a total of $1,900 also. Okay, so this represents the money that later people have come in and deposited that they got from the people who were loaned the money. So altogether, my liabilities are $2,000. $100 to you, the original depositor, and $1,900 to the various creditors that have come and deposited subsequently, but really deposited the same money, just coming back and back around. So of my total liabilities of $2,000, I have a deposit of $100. That's then a 5% reserve ratio. Okay, and so that might be within the government mandate. The government mandate that I have to have at least 5% worth of reserves. So that's the story according to the traditional fractional reserve banking, which crucially does not happen these days, okay, generally speaking. What happens these days is a different process called loan credit creation, which ends up with a balance sheet which is effectively the same, but it does it in a different way. So let's talk about that. So let's rerun that same scenario. You come to me with your $100. I say, thank you very much. Okay, I'm taking that $100 and now I'm going to put it into my vault and I'm not going to touch it subsequently. That's there and it's not going to be lent out. Nothing's going to be done with it. It's going to stay in my safe. What I'm going to do correspondingly, okay, I have to acknowledge your deposit, give you a deposit account with $100 there. So at this stage, we have $100 on this side, we have $100 on this side. Then what I do is I make the calculation and I figure out how much loans could I create so that I'm still going to stay within the 5% range. And I make the calculation that I can lend out $1,900 of loans. So that's what I do. I go out and I get people who need loans and I write loans for them. So I write loan contracts here and correspondingly I open credit accounts for them on this side. That's all done just on the account level. These are just entries, bookkeeping entries that are happening here. Okay, so that's what happens. So at the end of this, the money has not even left the vault. It's just right where it was to begin with. But I have used this deposit to support the creation of $1,900 worth of loans and correspondingly $1,900 worth of credit. That's the loan credit creation. That is essentially the main business that banks are in these days. So perhaps you can see why there's a bit of instability to this, right? Because all these creditors, the original depositor along with these other creditors, they are all claiming, they all have a claim to my money. But actually, to satisfy those claims, I actually only have $100, the original $100 you gave me. So there's $2,000 worth of liabilities out there, but I only have $100 to meet them. Of course, that's not entirely the case because I still have those loans, right? The loans are there on my book and they represent an asset, but they're not a tangible asset that I can draw upon in the case of an emergency. If a lot of these people want their money back, I can't go to the loans typically, which, maybe 10-year loans or 20-year loans or 30-year loans. I can't go to them and get the money out from them. So that would put me in a difficult position. So this is inherent in the nature of modern banking. Okay, and it's crucial that one understands this. Now this gives me a chance to clear up some confusion which is quite widespread in public commentary on economic issues having to do with central banks. It has to do with this term printing money and the idea that banks create money. Well, yes and no, okay? So let's be a little bit more precise. The term printing money, what should that refer to? I think it should refer to what it actually is the process by which the Treasury instructs the mint to print money. So they're actually printing presses, there's huge sheets of paper coming through, and these presses create, money that looks like this, okay? That's printing money. Banks, of course, do not do that. Banks do not have printing presses in their basements. So what do banks do? Well, some people say something like, well, the banks create money. They just create money out of thin air as credit. That's not exactly true, and it's a bit of a misrepresentation to think about it that way because it only deals with one side of the balance sheet. In accounting, we need to look at both sides. We have to have a picture of the assets and the liabilities. So what's more accurate is to refer to loan credit pairs. That's what the bank is doing. It's creating loan credit pairs. Okay? It's making an entry on the asset side, it's making an entry on the liability side. And those two entries are equal and ultimately opposite. And their total effect is ultimately zero. So this is what banks really do. Although effectively it can have the effect of creating more money, because the credit that's created on the liability side, well, that means that people think that they have this money in the bank. In fact, they do have, money in the bank, in the sense of their account balances show some monies there, and they could actually use that money to go out and buy things. But what that side doesn't take into consideration is that on the other side, there are correspondingly people who are in debt, who owe money. Like they have negative money, you might like to think, right? So a mathematician, there's a plus sign here and there's a negative sign here. The total is zero, okay? And so if you ask, well, how much money is there? Well, there's plus $5 here and there's minus $5 there. Well, it's still $0, really. Even though if the minus $5 is sort of hidden, which often it is with debt, okay, people don't advertise their debts, that's sort of a secret. So it may look like there's money because this plus $5 is rather visible. But from a mathematical point of view, that's not what's happened. There's actually a total of zero money created by such a loan credit pair. And this makes sense because you can't create something out of nothing, right? The idea that banks can just create money out of nothing is a distortion of, I think, what's really happening. So to give you a little bit better idea of this inherent risk that's underlying the banking system, let's remind ourselves of this primary school game called musical chairs, where you've got a number of chairs and an equal number of kids, and the music starts, and the kids walk around, and eventually the teacher takes one chair away, the music stops, the kids have to run, and only 4 of them get chairs, and the other one is out. And then it continues until there's only 1 chair and 1 kid, and that's the winner. In modern banking, something like that is happening. Okay, but it's a kind of an opposite kind of musical chairs. So here's 5 chairs, here's 5 people. The music has started. The people are walking around. And what happens is that as the music is playing, the door opens and some new person enters. And then a little while later, somebody else comes in. And then a little later, another person. And more people are coming in. We're all walking around this central area where the chairs are supposedly there. And, if you talk to them, why are you here? Oh, well, I've got a chair. I've deposited a chair with this bank. Okay? But that's not really what's happened, right? I mean, what happened is we have a fixed number of chairs and we're increasing the number of people that have a claim to those chairs. That's sort of what's happening. And this can ramp up quite dramatically. I mean, in the example that I was showing you with a 5% reserve ratio, right? You start with 5 chairs, you're going to end up with 100 people here before, you've reached the level that we were talking about. Okay, so these 5 chairs are going to support 100 people. There's 100 people walking around here who all think they have a claim on the chair. So in order for this to work, 2 things have to happen. First of all, the bank needs to put the chairs in a vault. Okay, they cannot be visible. If the chairs are in the middle of the room and there's 5 of them there and we're all walking around, well, it's obvious that somebody is being fooled. Okay, but if the chairs are in a vault somewhere where we can't see and we have no access to that, well, that's one safety criterion. The other is that the music doesn't stop. Okay, as long as the music doesn't stop and this just goes on, and we're never in a position of having to rush to get our chairs, then the situation and the danger that lurks under this situation is kept at bay. And you can think about the central bank as being sort of trying to minimize the dangers here in 2 ways. That first of all, the central bank has a reserve of chairs. So if there's something happening with my bank, the central bank can lend me some chairs temporarily so I can deal with all these people who want their chairs back. And also, the central bank is kind of arranging or trying to make sure that the music doesn't stop. Okay? central bank is trying to maintain levels of confidence so that we never get to the brink and have to face the possibility of collapse. Does it mean that central banks are always successful? Of course not. Collapse can still occur. And that's going to be an important issue for us. Now, one of the other things that's really important for central banks is the currency and maintaining the integrity of the currency. And this is complicated these days because in the 20th century, we've had this major development that almost all countries have gone off a gold standard. It used to be gold standards or silver standards pretty well universally. But gradually over the 20th century, these have been reduced, and we are now basically all using fiat currencies. It means currencies which are not pegged down to tangible physical assets like gold or silver. So this is a general 20th century trend that sort of reached its apex in the early 1970s. Richard Nixon in the US officially disconnected the US dollar from the gold standard, but it had actually been moving that direction for quite some decades before that. And from my point of view, this is a really crucial development in modern finance. In fact, from my point of view, there's really three outstanding aspects of the modern financial landscape, which are really 20th century developments. And in order of importance, okay, they are, the first is, for me, the rise of bonds. That is the single most important development in the financial landscape that determines where we are now. Okay, and so we're going to have to talk a lot more about bonds. And the second most important thing is exactly this shift from gold to fiat money, which is an experiment that we're kind of conducting here on this international stage, really for the first time, really. So this is a work in progress, and how it's going to end up is still to be determined. The third really important development is the huge global population increase, which is not, at least at first, immediately connected to finance, but it has huge financial implications. So the demographics of the 20th century have played such an important role in the financial structures and what's happened. So we're going to talk a lot about these things. But it's important to realize that the 20th century was a really innovative century finance-wise. So these developments and others have generated a landscape which is very different from previous generations and previous millennia. Okay, so that the task of setting up a central bank early in the 20th century, which I was involved with, is now quite different from the role of a central bank nowadays in modern times. So next time I'm going to give you a brief history of central banking in Europe, where this dark art had its origins. Hope you'll join me for that. I'm Norman Wildberger. Thanks for listening.